So what do we got for the housing provider tip of the week here?
I think right now in the economy we're in, and the concerns about recession, downturn, all that stuff. I think when you're underwriting applicants, I think making sure that you're using the whole debt to income ratio is more important than ever. Think about it this way: credit card companies, banking institutions, they're really worried about Americans having too much debt right now, and that means that us as underwriting people that want to live in our house and we're expecting to pay us right now, we should definitely be paying attention to. So make sure, debt to income, it's basically pulling from their credit report, their estimated expenses on a monthly basis, and making sure that, taking that dollar amount, let's say they have a $2,000, car payment and a $500, debt consolidation.
$2,000 car payment.
Yeah, whatever. A $1,000 car payment. I've seen that. But you have all these different things. You add that up and you add that on top of what their income is, and look at how that compares to, what you're asking. So if people have all these outstanding things, a lot of times they're going to pay that before they're going to pay rent, because they're going to have a bigger penalty for not paying that car payment, or a bigger penalty for not, paying something that's already in arrears or something like that. So take that into account. And one other thing I want to say to that I heard this on another podcast this week too, is when you're taking that into consideration, then you got to put their whole cost of living in. And the crazy thing that I never really thought about this way, but think about this: a $5 or a gallon of milk costs $5 for a guy that's making $2,000 a month or making $200,000 a year. Like that, what it costs to live or feed yourself a lot of time costs the same amount of money. And it's kind of a crazy concept that we don't, a gallon of milk is a lot more to the guy renting a $900 apartment than it is a $3,000 a month apartment.